Okay, guys, let's get to the cow. Here we are doing a paper March, the recent paper from Limpopo. We are doing question 1. Remember, we have already done a question. I think yesterday we were doing, or the day before yesterday, we were doing question 3, which is a cash flow, or question 2, if I'm not mistaken. Okay. Now we're going to see question 1. Fortunately, it's just a pre-record session, this one. I'm not on a live session class. So, okay, then Masia, get back to the cow. Now we are asked question 1 to prepare income statement. What are the information below relates to Maleka Ltd. The financial year ends on 28 February, as we can all see over here, 28 February 2022. Required, complete the statement of comprehensive income statement for the year for 40 marks. Ended 28 February 2022. Okay. Now you know when you are going to do income statement, you start with your sales. Yeah? Okay, starting with our sales. They have already given us sales from the what? From the pre-adjustment. The only thing we need to do is to check those sales from the pre-adjustment, which is 8. As you can see here, they have already given us this sales, which is 8,800,000. Okay, you take those sales, you open the brackets on your income statement, you first put the figure, you will see tate upper pre-adjustment. Then see, check do we have it debtors allowance? We are still checking from the pre-adjustment. Is it the system of pre-adjustment? This sales from the pre-adjustments, the debtors allowance from the pre-adjustments. So first thing is okay, we have it debtors allowance 19,200 rands. So it debtors allowance sales, it will affect our sales negatively. So we decrease our sales net debtors allowance, which is 19,200 rands, of which I know I don't have to explain that. Grade 10 11. Okay. Now, after dealing with debtors allowance and sales, then you go to additional information and check whether there's no transaction that is relating to sales. Additional information. Remember, guys, there's no sales that have taken place that are not recorded in the books, or there are no sales that has been returned. Okay, there's no stock that has been returned by a customer. Are we together? So we are taking those types of transactions from our adjustment. Okay, my strong which one up at the business price its goods at a markup of 60% at cost. Trade discount of 360,000 was allowed on an invoice to certain custom. Okay, so this is a discount allowed, which is an expense. A trade note for 49,600 issued to a debtor dated 25 February 2022 was recorded as an invoice. So do you see the error here? What we did, we recorded a credit note as an invoice. Remember, good people, when do we issue a credit note? A credit note is issued when there's a return. When there's a returns, remember that. Okay. So now we have issued a credit note, but we treated it as if this customer was buying, yet the customer was returning stock to us. I hope it makes sure, guys. So that means, okay, this is an error that we have done as a business. How do we deal with such an error? Remember, guys, Lemali says if we sales as if there were sales taking place. So we need to correct that error first. So we need to take out that amount from the sales first. Then again, because these sales has already taken place previously on previous sales, then guys, stock 49,600, but now he's returning the stock back to us. So in the we were supposed to subtract, because these sales that we have decreased. This stock that we have already sold has decreased because the customer is returning the stock. But instead of subtracting the 49,000, we added the 49,000. I'm not sure whether it's making sure. So that means to correct this error, firstly, we'll have to subtract. I will show it here. I'm sorry, Penium. It's a little bit slow. Okay, so first we'll have to subtract the 49,000 that we added on our sales. Order sales, no sales took place. So we added 49,000 on top of our sales, whereas there was no sale taking place. Then, okay, we subtract the 49,000, and again we subtract the 49,500. This is what we were supposed to do in the first place. We were supposed to subtract the 49,500 because this, when we issue a credit note, that means a customer has returned his stock. Are we together? So now this means we will subtract double the amount, the 49,500 rand. You can separate it. The 49,500 rand is correcting the error that we have done. Then the 49,000, the second 49,000 rand is to what? Is to do what we were supposed to do in the first place. I hope I'm making sense, guys. So it's 49,500 by 2 times by 2, which is 99,000. When you add these figures together, they will give you, in other words, you can almost subtract 99,000. Okay, so you go to your income statement. Is either you subtract 49,500, fucking a mistake, we sales, then again we subtract 49,500 because the returns is okay. Then again, I'm sorry for closing that, but angikacheki ukuba ayikho na enye transaction that will affect the sales. So we have to check as well if there's no other transaction that will affect the sales. If there is a transaction that will affect the sales, we need to deal with it accordingly. Okay, so we'll see a data P Malema with a custom balance of outstanding balance of 49,000. So this 42,000 has left the country. Okay, the provisional for bad debt. Okay, remember I always say with students, if you read the first transaction, the second transaction, and you come across 2 transactions or 1 transaction that ingekho relevant kule into besiyifuna okanye outside le sales. So that means a cost transaction onophinda uyifumana ndakuba sense now. So because remember in this transaction was affecting sales. Okay, so we read the next transaction is not affecting sales, and the second transaction after that one is not affecting sales. So we need not to bother ourselves because the jam case ayikho any transaction is affecting sales. Okay, then we can close our account. We can close our income statement. So you punch the calculator for me on your side. I will punch on my side as well. So punching on my side, I will getting 8,681,000. 8,681,000. 81,600. Okay. Now. Okay, Masiel, can go back to the cow again here. We cost of sales. Now the question around the cost of sales, what are we given regarding the cost of sales? We are given a question mark over here for a cost of sales. Okay, and also let's see, is there anything said about the cost of sales? The business prices its goods at a markup of 60%. Okay, on cost, trade discount for 360,000 was allowed on invoice to certain customers. Okay, now when we deal with that figure over there, how are we to calculate it? So, okay, so how are we to calculate that amount? Remember, you are having your nets, your sales now. We are going to take our sales amount. This sales to guys. Remember, this sales to it's 8,681,000. Before we use a markup, we need to first use those sales because we are looking for the sales. Before we use a markup, we need to add back the what? Okay, let's see. It's 8,800,000. And here we are told that there was 360, which was a trade discount. Are we together? Was allowed on invoice to certain customers. So a trade discount, because now our bank bona be a trade discount. Abantu using a trade discount. That means bona abatengi a product to business with normal price because they are our regular customers. So what we are going to do, that means, okay, if we were selling, let's say, if we were selling something at 20 Rand, then if it happened that regular customer, so that means your sales figure for that regular customer will be 15 Rand. Are we together? Unlike something that a discount where we give someone a discount based on earlier. That's different, guys. But now we set up only a trade discount. So that means the trade discount has affected his sales. In normal discount is affecting his sales. So the sales that we are seeing there, this is a record share with a trade discount. That means we have to add back the trade discount before we could calculate the cost of sales. I hope it's making sure, guys. Okay, so the cost of sales, it's 8 million. To calculate the cost of sales, we are going to take the sales amount, which is the turnover, which is 8,681. $681,600. Okay, then what we do next, we add back that trade discount, which is 360,000. Then only then we multiply with the percentage we look for. Remember, cost of sales is sales are always equivalent to 100 plus a markup percent in terms of the percentage. Are we together in terms of the ratio? Then that means the cost of sales are always equivalent to 100%. Then the gross profit is equivalent to the markup percentage. I hope it's make sure. So we are going to multiply by 100. We are looking for the cost of sales, which are equivalent to 100 out of what using the total turnover here is equivalent to 100 plus markup, which is 160. So what are we getting? You punch calculator yako on your side. So we are getting what? $5 million. Can I? 8,681,600 plus 360,360. Sorry, I forgot another zero. Okay. Multiply by 200 over 160, which is giving us 560, 5,651,000. 51,000. Then space with brackets Z2 guys. I hope siyamba sonke. Then you calculate your gross profit from there. You take this, you separate this one. Then okay. So that means over here they have given us the business price its goods at a markup. This is the markup achieved. Ne? So we suppose Baba specified, this is your markup achieved. So while usebenzise is that means you are using markup achieved. Okay. So you take this, you separate this amount, which will give us how much? You take 8,680,600, separate 5,651,000. Then you will get on my side, I'm getting to 3,030,000 and 30,600. Remember, guys, it's over fast because of load shedding soon. So and those was slow. Okay, then we are done with the first part, the trading part. Then we go to other operating incomes. In other operating incomes, rent income. So the first thing that we need to do about rent, we have to go and check rent income from our pre-adjustment. Luckily for us, the pre-adjustment it's having two columns, debit side and the credit side. So you know under a nominal account section, that's where you will find your incomes and your expenses. So our income will find it on the credit side. Ne? Remember, good people, we said once when we spoke of add the sale. Add the sale, we said each asset, each drawings, the expenses, they all increase on the debit side and decrease on the credit side. Capital income liabilities are increasing on the credit side and decreasing on the debit side. So that means the income is having a credit balance. That's why you will see it upper with credit balance. So in rent income here, according to the pre-adjustment right balance is 70,500. So we take it, 70,500. Ask us to get transaction. Then we go to the transactions and check which one with transactions. Transactions regarding a rent. We check for a transaction regarding a tenancy, rent. So we check for those types of transaction. Anything said about the rent. So physical, the provision, and data. Okay. We move down. There's another new transaction evidence, income tax, audit report, operating income. So fortunately for us, it seems as if there's no transaction that will affect the rent. So we are so fortunately kulena the case which is in the. So you take rent yako as it is versus so you 70,500 rents. Okay, then we go for a provision for bad debt. What are we really looking for? A provision for bad debt? You are checking your old versus your new provision for bad debts. Ne? Okay. Or you are checking for what? For an increment, or a detriment. A decrease on your provision for bad debt. So these are the two things that we are checking, whether if we are given the adjusted figure, the adjusting figure, we are going to take it, whether is it an increase or a decrease, né? Or we are given the new provision for bad debt or the old provision for bad debt. Okay. So now from the pre-adjustment, you will get the old provisional for bad debt. Let's check them out under a balance sheet session. Provision for bad debt under balance sheet section. Here we are having provision for bad debt as 3,200 and what? It's 3,240. Okay, then we move and check for the new provision for bad debt. What is said about the provision for bad debt? A data, here it is. The provision for bad debt must be adjusted to 5%. Must be adjusted to 5% of the custom duties. Of the custom, of the outstanding data. Sorry, wrong, guys, of the outstanding debtors. Okay, so now how do you get the outstanding data? They are meaning the trade data. How do we calculate for a trade data? You take debtors control, the debtors control on your pre-adjustment, and you subtract your what? Your bad debt on your what? On the adjustments. I hope it makes sense, guys. The new bad debts on the adjustment. So let's go and check for debtors control. Our debtors control figure according to our pre-adjustment is what? Is 186,000. So we are going to take that 186,000 rands and subtract what? And subtract our bad debts. So our new bad debts, which is a trade, sorry, Nancy, a data P in transaction C, if you remember, a data P Malani with outstanding balance of 42,000 has left the country. His account must be written off. So the account will be written off. So anything that we write off, these are the new bad debt. So we are going to subtract new bad debt to 42,000. So we are going to subtract that 42,000, which will give us in return 186,000. So we 0 upper 186,000 minus 42,000 rands. Okay, it's 144,000. Okay, so this is our figure here. Okay, so we take, what are we going to do with that 144,000? This is the 144,000 that we are going to calculate our 5% with, yeah? Which is our new provision for bad debt, which is 5%. So now we are going to multiply this figure with 5%. It's 7,400. It's not make sure. Did we take the correct figures? Okay, the provision for bad debt. It's the guys. Debtors control was 186,000 minus the new provision for bad debt, the new bad debts on 42,000. 144 multiplied by 5%. So which is the new provision for bad debt according to them. Okay, Ayiko, and let's check another bad debt. There's nothing said about A traded note issued for a debtor. Oh, remember there's this transaction as well we were supposed to account for. A traded note issued for a debtor was recorded as an invoice. So also there's this 49,000 rand, sorry. Remember, because it returns is by a debtor. So it returns by a debtor, zidithrisa ntoni ityala le debtor. So before, guys, I forgot about this transaction. Before we account, before we use that 5%, we need to first, let's go back to our debtors amount. So it was everything that is affecting it debtors. So the first thing that it was affecting it debtors was that figure, those returns, which were 49,600. So we have to subtract the 49,600 because now this data is no longer owing us. I think it's 49,600 and 49,000. Is it? It's 49,600, 49,500 or 600? 600, 49,600 rands. 49,600 rands. It's 49,600 rands. Okay. Then again, minus alone, bad debts guys for confusing you. Okay, so what I'm trying to say is that you take a trade, data your adjustment, and you check for transactions that are affecting your data. The new transactions that are affecting your data. If there's a data that was not recorded, was if there's a new sale that took place during the year and was not recorded, and that sale was on credit, that means the data control will increase. But if there's a return of stock that was not recorded, that means, and if that stock was bought on credit from us, that means now our debtors will decrease first before we check for the bad debt. Are we together? Because a bad debt okay, bad debt will decrease our expected amount from our debtors. I hope it makes sure, guys. So now, if bad debt is to it 42,000. Then that means, okay, we're going to take that 186,000. You subtract 4,960, 49,600 minus 42,000 again. Being 42,000 only, ne? Yeah. Okay, I want to double check my figures. Mistake. Then you will be getting what? 994,400. So this is now our trade data. Ne? Our trade data, the amount that we are expecting to receive. From the amount that we are expecting to receive from our debtors, we are to calculate 5%, which will be 4,720. 4,720. Okay. 160. 49,600. 186. Let me double check my calculations. 49,600 or minus 49,600 minus 42,000. Okay, so guys, and also remember, the transaction, this was not ordinary returns. Again, Iphinde ngalibala enye ifigure enye into ebalulekileyo for the last time. Remember, as returns besizifake besiziminus kabini kwi-sales zethu besiziminus as ku-92,000 ne. So nalapha we have to subtract them twice. We subtract them because sesazongeza kwi-sales, that means sesongeza qala sese-assume as if this customer is buying on credit, so we increase the expected amount from e-debtors, ne? Of which we were not supposed to do that. Okay, so we'll take this amount that we are subtracting here is for that. And then for the returns, we again subtract another 49,600. Okay. And that's no bakuba ndingxamile guys. Leqa lombane. So izinto ezithile ndicinga sendizenzile ndiyaxolisa. Kakhulu for taking your time and for causing confusion apha kuni. So remember why this 49,600 is appearing twice. We are subtracting twice because okokuqala 49,000 thina sesamtreata as if lo muntu uthathe ngetyala kwakhona ne. So sesamtreata as if uphinde wathenga le customer ngetyala, of which that was not true. So that means sesongeza kwityala lakhe 49,600. So we're supposed to subtract elatyala silongezileyo kuqala. And then at the same time, from his existing debt, then we have to subtract 49,600 because we see the stock. He have returned the good. That's why this figure is appearing twice. Then after doing all those calculations, you want to take 186,000, which will give us the correct figure will be 44,800. Remember what was guiding me, Ukuba, this amount that we were getting are wrong. Ne? When I check because debtors, they have given us provision for bad debt as an income. So that means the new provision for bad debt must be less than the old provision for bad debt. So then I multiply by 5%. So whenever I'm getting a new provision for bad debt that is greater than the old one, that's a red flag. Multiply by 5%. So it's 44,800 multiplied by 5%, which is giving us 2,240. Now it's making sure because it's less than the old. So the old is this one. Now the new provision for bad debt is 2,240. Guys, I know been shaky lepana a little bit. To some maybe then they confusion. Okay, now so 3,200 for the old. You take the old, you subtract the new. Remember, if old is greater than new, when you are calculating provision for bad debt, you are having an income. Your difference will be an income. That means now the provision for bad debt has decreased. So what decrease it's an income. Then who increase it's an expense. It's an expense. Okay. Okay, so these are very important to know. Okay, so we are going to take the old provision for bad debt, which was 3,240. Then we subtract the new provision for bad debt, which was 2,240. Then you punch calculator yako and give me a difference. The difference will be 1,000 rands. Oh, sorry, then you add because they have first negative block up. That means any other operating income that we have to look for. You just add your 70,500 plus 1,000, which is going to give us 71,500 rands. Okay, then now you add your gross profit. You add your gross profit with your what? With your operating income to get your gross income or your gross operating income. So we are going to take the 3,030,600 plus 1,500 and see what we are going to get. We are going to get 3,100,000. It's supposed to be 3,102,000. 102,100 because it's 6. No, it's 100. So 100. Penny, I'm sorry, guys. It's a little bit slow. Okay, then we are done with our income. Let's go and check expenses. Expenses we're having is salaries and wages. So we go to e-adjustment. They have given us the figure from the pre-adjustment already. So we have to go to e-adjustment and check e-adjustment Z2. Anything that have something to do with anything that has something to do with wages. We are given here information F. What's in information F? One employee received a double salary by mistake. Okay, so maybe this one is new. So this employee received a double salary by mistake, which means he was paid in advance from the salary journal for February 2022. This must be reversed. The employee made a direct deposit to the business account as a refund on 28 February 2022. His normal salary details are as follow. Okay, normal salary details is as follow. The pay as you earn is 3,000, pension fund is 2,000, then the employment contributions it's 4,000, total employment in net salary it's 15,000. Are we together? So now when we speak of his salary, as you can see, when we check, you first check whether, okay, let's go to employee contribution are part of salaries and wages. Okay, I couldn't need when they check and checker because when they check ukuba ingaba contribution are separated from our salaries. So they have told us that as separate, then that means okay to calculate salaries because they are not separated. It's to calculate in salaries, it's gross salary plus what? Plus the contributions. Plus the employees' contributions. So this will be our calculations. You need to calculate the gross salary of this individual and the contributions. You add the contribution by the employee. Or the employer, sorry. Now, okay, the employer's contribution is 4,000, it's clear. So we are going to add it there. Then we have to calculate it gross salary for the employee. How do we calculate gross salary? We add that deductions. Deductions are pay as you earn and pension fund from a net salary. So that means our calculation would be 15,000 plus 2,000 plus 3,000, which is 15,000 plus 5,000. Okay, so we add deductions, which is 5,000, and is that deduction 5,000, 2,000 plus the 2,000 plus net salary because we have to add them back all. Net salary which was 15,000, and on top of that we add in with the contributions by the company, which was 4,000 rands. So which was 4,000 rands. Sorry. Okay. Which was 4,000 rands. So how much are we getting? Oh, sorry, we are not supposed to add, we are supposed to subtract. Remember, this is in advance, it's not omitted. It's a mistake. Remember, we are to, let's change either additions to a subtraction, or you can to make, because it's in space. Omnye bezotime namene ndiqale ndazidibanisa i-gross salary yakhe ecaleni. So i-gross salary yakhe it's 15,000 plus 5,000, which is 15,000 plus 2,000 plus 3,000, which is 20,000. The gross salary is 20,000 plus the contributions of the employee, the employer, which is 4,000. So now also we are subtracting now as well, because we are subtracting because easy they paid in advance. Okay, so 4,000 you minus 20,000 you minus 4,000, which will give you 657,000. 600. Guys, I hope okay, the advertising, training advertisement. So they have given us the figure from the pre-adjustment. So let's check additional information here too regarding the advertisement. Button. Our advertisement, advertising of 40,000 consists of a month-to-month contract with local radio station. Advertisement was paid for 13 months from 1st November 2021. The contract rate was decreased by 10%. Okay, advertisement was paid for 13 months from 1st November 2021. The contract rate was decreased by 10%. So if this advertisement is for 13 months, that means there's a month in advance. There's 1 month in advance, which is not belonging into this accounting period. Remember now, okay, there's in your timeline. To answer a question of this nature, you have to have a timeline. Timeline yako, unyaka wetu kala, uphela ngoFebruary. So March, it's March, April, May, June, July, August, September, October, November, December, January, February. Yeah? Okay, so it's Feb, it's March, yeah? April, May, June, July, August, September, October, November, December, then January, then February. Okay. So they are telling us now, February 2022, this is our year end, February 2022. But from 1st November, there was an increment. Remember the 40,000, advertisement of 40,000 consists. So this 40,000 that you see is for how many months? Is for 13 months. And yet, Tina, we are looking for advertisement for the 12 months. Okay. So, the advertisement, the contract rate was decreased by 10%. From when? From November. So, from November, 1st of November, there was a change. Yeah? So, all these months to this side, remember there's that month that was in advance, the 13 months. So, it's February and there's March that was in advance. So these months that are on the right hand side, they receive a decrease of, we subtracted to 10%. So when you subtract 10%, so we assume that before it decreased, it was 100%. So when you subtract 10%, you'll be left with what? With 90%. So now our expense was 90% as compared to the previous amount that we were paying before the change. And that's not in the sense now. Before change, it's always 100% if the change is in percentage. Okay. So now we are looking for this month. We want to subtract this amount here. So we are going to use the formula which we normally use even when we are calculating a rent at times. So in formula guys, I will calculate for a monthly advertisement, ne? With a change, ne? After or the after, to make it easier for you, after the change, which is after the decrement, ne? After the change, banya economics nizoyazi le side or mandibale when ungayibhala in full, it's a monthly advertisement. After what? After change. Because or after detriment. After detriment. Okay, when the bala in full must be equal to or equal after change, like this. Okay, so now it's after change. So what we are going to do, we are going to take the advertisement as per the pre-adjustment. Advertisement is on the pre-adjustment. But remember, we are not focusing on exactly the advertisement of the pre-adjustment. This amount that we put on the pre-adjustment, the 40,000. And what else we divide by the month with no change. Are we together? This is no change plus a month affected with a change multiplied by that change. Then again, because we are looking for a monthly advertisement after change, then we multiply everything by the change, by the increment, in fact, increment ratio or increment percentage. Okay, this means we are going to take the 40,000 doing our calculations. 40,000 we divide by how many months before change? 1, 2, starting from March, 1, 2, 3, 4, 5, 6, 7, 8. So there were 8 months without a detriment, before it decreased. Then how many months were affected by the detriment? 1, 2, 3, 4, 5. So we are going to add 5 months, but these 5 months we are going to multiply them by the change. What was the change? The change in conclusion was 90%. The ratio of the change was 90%. So we are going to multiply them with 90%. Then again, we multiply everything by 90% because the change is 90%. Then you give me answer. See, you are getting what? The calculator yako. $2,880. 880. Guys. So this is 2,880, which means this is the monthly advertisement after change. So which means after we have used the percentage, we have adjusted to 90%. So after the detriment, the advertisement was 2,880. So surely for March it was 2,880 because March is after the detriment. So this is the figure, the amount that we are going to subtract. This is the prepaid expense that we are going to subtract 2,880. Then we are getting what? We are getting 57,000. 57,120. Okay, see we bet that if bet that we have to add as a new bet that if you still remember the column to bet that from our adjustment. A data PM outstanding balance of 42,000 has left the country. 42,000 is bet that so basically writer of Lamdu. So we have to add the 42,000, which is going to give us how much? 48,750. 750. Okay, then say we're packing material. With packing material, we want to pack material used. So we take packing material from the pre-adjustment and we subtract the packing material on hand. So let's check for a transaction regarding the packing material on hand. There it is, transaction E. Yeah, we have used this transaction. Okay, transaction A equal to the physical stock taking on 28 February 2022 reflected the following stock on hand, which is a packing material to 6,020. 6,020. 6,020. Simbeka upper. See, I'm subtract of 6,000 and 6,020, not 620. 0.20. Then we are going to get how much? We are going to get 6,000, 15,000 plus. Oh, sorry. We are equal any information regarding to the packing material before we subtract. Is it sure? Okay. Packing material. It's kufumana bani? $980. Which one? 9,000? 8,980. Okay. Let's double check everything first. Before we conclude, consumable stores on hand packing material, there it is. Consumable stores on hand packing material, March 2021, at the beginning of the year. So remember, as the consumable stores the previous. Ne? Sivule unyaka sinazo. So sivule unyaka sinazo siyas add because nazo they are to be used. Ne? So we add them because on top is tenga guys, ne? Tenga AZP 15,000 as purchased during the year. There's the already existing consumable stores, which was 820. So that will give us what? How much? 9,800. Okay, we are done with consumable stores, your packing material. Ne? So after packing material, we go to the adjustments and check director's fees no. So director's fees is still outstanding, so must be our director's fees. Then we check if there's any transaction relating to the director's fees. Director's fees 550,000. So we check, is there any transaction coming and the transaction is necessary? As you can see, I can be quantitating director's fees here. Share capital, dividends, operating profit, income tax, audit report. There's nothing. spoken of the directors fees. So the directors fees to start as they are. CBS says Faga. So you take it as they are, so 550,000. Okay, CBS sibuya siyojonga yintoni ezantsi kwe-directors fees, audit fees. Nazo ngobe ndijonga bendisihla phana akho nto ithethekileyo ngazo audit fees, but you will check now on your own time. Audit fees, there's nothing spoken of them, so starter is they are, which is malini 188,000. 188, and as we find in 188,410. Okay, then sibuye sibe nantoni enye after audit fees, salaries and wages sesiyisebenzisile. It's a tick. Rent income, it's already used. Interest on fixed deposit. Hey, interest on fixed deposit 80,000. Remember, interest so ingena phi ezantsi izozongena apha interest yakho, interest income. So besiyifaka apha yona because asikazi into ngayo la 80,000. Okay, then ibe yintoni enye, so ithetha ukuthi interest on fixed deposit sesi interest on loan, nayo interest on loan atfake i-question mark, so sisezoyicalculator. Sibe ne-advertisement sesisebenzisile, so sibe ne-insurance, umshwalensi, so siye kuye umshwalensi IFA insurance. Okay, so insurance yethu sichekishe ukuba is there anything said about the insurance on our transactions? Okay, by the looks of things, ithi class yam ayikho into ethethekileyo nge-insurance. So we take umshwalensi ngeli hlobo alilo, ne? Sihambe siyomfaka phayana insurance yethu, which is how much? 14,700. Okay, we move on to the next one following the next expense following umshwalensi, yintoni? I-bad debts. I-bad debts esisebenzisile. Okay, it's a tick. The insurance, it's a tick. Then we have packing material, of which is we have sundry ordinary share capital and sundry expenses. Sundry expenses, so balancisa ngazo, unless kuko individuated ngazo engenye. So your sundry expenses normally udla ngobalancisa ngazo, ne? So uzabuzishiya phana i-question mark yazo. Then sibe siqhubekeka siye kwezingekhoyo ke ngokwi-pre-adjustment. The expenses that are not on the pre-adjustment, that you won't find on the pre-adjustment, the depreciation. Ne? So we have to account for depreciation, and also we have to check starting with depreciation one step at a time. So with depreciation, remember, good people, whenever you are calculating depreciation, I always say that you have to calculate depreciation number 1, depreciation number 2, depreciation number 3. As I told you, information is in regarding depreciation on our assets. So is investment depreciation the assets. So we are to calculate depreciation number 1, depreciation number 2, depreciation number 3. Okay, what do I mean by depreciation number 1? Depreciation number 1, you calculate on the old assets. What do I mean about the old asset? I mean assets that have been in the business for more than 12 months. Then with depreciation number 2, I will calculate depreciation number 2 on the additional assets during the year. I will together on additions. Then with depreciation number 3, I will calculate with depreciation number 3 is the depreciation for the sold asset during the year, or your disposed asset. Ne? Okay, so now we have to check, do we have a disposed asset? If we have a disposed asset, whether it's on which type of, because the asset is A2, there are 3 types of non-tangible assets that we know of: the equipment, the vehicle, the land and building. So we check on those assets. Do we have E sold? Do we have E disposed? Do we have addition? So now I always start from the back when I'm calculating my depreciation. So let's go and check for the information here regarding to the assets. We are given the assets there too. We are given equipment, we are given the vehicle, we are given land and building. So land and building, we know that in a depreciation. So we are going to check only for the 2, for the vehicle and the equipment. Accumulated depreciation on vehicle, we are given our accumulated depreciation on vehicle. These depreciation are before we calculate the depreciation for this current year. Are we together? So that means this accumulated depreciation may be accumulated depreciation at the beginning of the year. Okay, let's go to information relating to depreciation. This is it, transaction page. But make provision for depreciation on vehicle at 15% on cost, which is okay. On equipment on 10% per annum on diminishing balance method. What one note, a new computer was purchased on credit on 1st June 2021 for 60,000. This has already been recorded. Are we together? So if it has already been recorded, so which means on the cost price that you see on your pre-adjustment, the 60,000 is already there recorded. Okay. So it was purchased when? It's very important, the date, guys. Take note of the 1st of June. Ne? Okay, 1st of June. So it's really for how many months? You start from June and count up to what? Up to February. Where do we see June? It's March, April, May, June. The 1st of June. So it's really 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So ayihlalanga inyanga ezingapi business. Sorry, it started from June. It's March, April, May. Ayihlalanga 3 months. Ne? So that means ihleli for 9 months. Sorry, ayibonakali le nansi kaya timeline yami. And those who ndenze put enye ngoku because of the time. You calculate June 1, July, August, September, October, November, December, January, February, because of February it's 9 months. Okay, we had this equipment for 9 months in the business. Okay, so we are going to use this to calculate depreciation. So for its depreciation, you will take 60,000. Remember, go to a calculator a diminishing balance method. I'm starting with the equipment. Okay, diminishing balance method. We are going to minus it accumulated depreciation. I remember when an asset is new, so it's having it accumulated depreciation and was 0. So we are going to subtract 0, then you multiply by the percentage rate, which is 10%. Then again, we multiply by what? After multiplying the percentage rate, we multiply by the months. The months zethu the 9. So 9 out of 12. So we are going to get what? 4,500. Okay. So this now we call it depreciation number 2. Remember, I said depreciation number 2 is on the sold asset. So now, what about the old assets? The old assets are the ones that we had. Them, okay, we are having depreciation number 3, way 2. Okay. Singabe siyombeka phayana ne we income statement yethu and depreciation number 3. So it's what? Yes, anyone? 4,500. Ne? Okay, so we are going to add it there. It's 4,500. So it's depreciation number 3. Remember the from the back. Okay, then now here with equipment again, because equipment you got is a sokolisa, the calculate again for the old equipment. So remember, the equipment, the incha the cost price is 60,000. We have to remember that. Ne? So 60,000 in the upper while cost price. And but guys, but this 60,000 is included because they calculate is included in this amount that you see over here in the cost price of the equipment, which is 200,000. This is the cost price at the end. So now to calculate the cost price for those assets that stay for the whole year, we have to subtract the 60,000 because it's included there. So we are going to take 2,000. We're calculating the cost for Ubani old. For the old assets. Cost for the old asset. So we are saying it was 200,000 and subtract 60,000 before we do anything. 60K. So which will give us what? 100 and